Dear investors, we are on the 20th edition of Wall Street Conference in Karpacz, Poland. My today's guest is the world-famous trader, Joe DiNapoli. Joe, it's a pleasure to have you here. How are you?
I'm well. Pleasure is all mine, thank you.
Joe, how did you become a trader and for how many years have you been active on the market?
Well, when I was a little boy, about 7 or 8 years old, I used to watch my father. He'd be sitting at the dining room table and he'd be looking at the newspaper and jotting down numbers and checking his stocks, see which ones he was going to buy and sell. And I'd be sitting there watching him, and I was fascinated by the whole thing. When I got to be about 15 years old, he was willing to open a brokerage account, a joint brokerage account for me. We went and saw his broker, and we opened an account, and I actually started trading. I've been trading ever since, and of course there have been trading breaks. My going to college was one of them. But I've actually been actively trading for over 40 years, and I have the scars to prove it.
Let's refer to the history of world's finance. Could you tell us which dramatic financial event has this special meaning for you? Was it the Black Monday? Was it the market slump after World Trade Center attack? Or maybe was it the financial crisis post Lehman Brothers collapsed?
Well, they all had really big significance to me, but in different ways. 1986, I was just getting on the seminar circuit. I was just starting to speak. And I had predicted in 1986 that we'd have a 500-point drop in the Dow Jones Industrial Average. At that time, people thought I was crazy, but I showed them the math, and according to my techniques, it wasn't crazy at all. It was something that was likely to happen. So, when it happened, it got me quite a lot of recognition. So that was important for that event. Later on, the World Trade Center event, that was obviously a large event, but it was again something that I had anticipated. Not the World Trade Center event, but some sort of event because of U.S. foreign policy. I was pretty sure something very bad was going to happen. I was thinking more along the lines of a dirty bomb, but it turned out to be the World Trade Center. It was no surprise to me when that happened. 2008 was an entirely different situation. That caught me flat-footed. I did not in any way anticipate that we were going to have that kind of an event, so I didn't anticipate that one at all. But here's the really interesting part, is that I benefited from the results of the 2008 debacle far more than I was able to benefit from the previous two. So you don't have to anticipate something ahead of time as a trader. All you have to do is know how to interact with the price levels in order to really make a lot of money.
So Joe, are you active when the blood is on the streets, or you prefer the quiet days?
Well, this is really an interesting question, and I'm glad you asked it, because being active when there's blood in the streets is where you can make a lot of money. However, you do not want to be active when the markets are in like a nuclear holocaust. And what I mean by that is, for example, on the 500-point down move that we had in the Dow Jones Industrial Average in 1987, this was an extremely dramatic event where even if you got a fill when you were trading that day, you weren't sure you were going to be able to keep the fill. I'll explain that in just a minute. The markets were extremely orderly after the World Trade Center event. They were very tradable. Blood was in the streets, but they were tradable. Same way with 2008. Markets were highly tradable. That whole period through 2008. It was a dangerous market, but it was highly tradable. Now, there was another event that you haven't mentioned, and that's the flash crash. That occurred in May 6th, I think, in 2010. The Dow Jones Industrial Average dropped 1,000 points and recovered in about 35 minutes. That is an example of a nuclear holocaust. Now, the reason you don't want to trade markets like this is that, let's say you're short and the market drops like a stone, you close your short position, you buy back in, and you've made, well, maybe 50 grand in the last 15 minutes. Now, market turns around, shoots back up again beyond the point where you have originally sold it. Okay, now, your trades, given the way the market's trading, your trades have the possibility, actually the probability of being canceled. So you're net short, you buy back, you're flat, you've made money. If they cancel the trade where you bought back, now suddenly you're still short and the market's now above your sell point. Now, if that happens, instead of making 50 grand, maybe you've lost 20. So you don't want to be trading in totally dislocated markets. And I've given you an example of two, 1987 and the flash crash. Other markets can be brutal, like 2008, like after the World Trade Center. Blood in the streets, highly profitable, and you have to be able to know the difference between the two.
Which are your favorite markets and which instruments do you use?
Well, I like stock market equity futures markets. Those are my favorites, but you know, I go where the action is. For example, oil, gold, and Forex, of course. I used to trade the agricultural commodities, but I don't do that so much anymore.
US indices for more than 1 year are below all-time heights. Should we expect growth to continue, or US bull market is just about to be all over?
The bull market is over, past tense. We have an indicator, it's called the MACD predictor, and this indicator is a derivative of the MACD. On a quarterly basis, if we get below that on the close, then we consider that we're in a bear market. According to that indicator, we're in a bear market in US equities, in European equities, and Asian equities. Now, the market hasn't fallen apart yet, but as far as I'm concerned, the bull is over with, and we have to watch out on the downside.
Joe, what will happen with the oil price? Should we expect that is correlated with the US dollar?
Well, oil is measured in US dollars, so by definition, you know, it has to correlate.
So what's the impact of oil market on the condition of the, you know, world's economy?
Well, oil is another interesting situation. You know, low oil prices are good generally for an economy, but if it gets too low, you know, it causes instability. Instability is not a good thing, and we see instability all over the place. So I think the lows in oil are in, and I am long oil in a variety of different ways. What's interesting about the oil market is that there was a whole lot of significant resistance between approximately 47 and 49 per barrel on the oil market. And we came right up to that resistance area. And normally what happens is we have some kind of a significant pullback from that resistance area. We haven't had it. All we've done is gone sideways. And what that tells me is that the oil market is in very good condition to go higher. Now, look what's going on in Israel. Look what's going on in the Mideast. You know, it's just going to take one event, and oil is going to go a lot higher. Now, whether that event's going to happen or not, I don't know. But the markets are telling us that that oil has seen its lows.
Dear investors, thank you for the first part of our interview. I would like to invite you for the second part, where Joe will tell us about the Chinese economy, and we'll talk about the Polish stock market. Joe, welcome in the second part of our interview. Let's talk about the Chinese economy. So, in your opinion, what is the impact of the Chinese economy on the performance or on world indices? And don't you think that China's role is overestimated?
Actually, I don't. First of all, let's just talk about China. I'm old enough to remember America in the 1950s and the 1960s. And when I first went to China, I saw the same kind of activity. This was a huge growth spurt in America. This is where the middle class in the 1950s and the 1960s, the middle class got not just one car, but two cars. They got houses of their own. They became of age. Now in China, you're seeing the same kind of a thing. You've got, I don't know how many billions of Chinese, smart, hardworking people, and they want what I have and what you have, and they're going to get it. As far as I'm concerned, this is the century of China. I mean, unless they somehow really screw it up. And the leadership there is good. The leadership is smart. So I think the Chinese economy is going to have a huge impact in the world. I think it's the Chinese century. I think they're going to overtake America. I think it's going to be an amazing future for them. And I'm there a lot. I go there all the time. And I can't say enough good about China.
Have you ever considered investing in Polish capital market? Do you know any interesting companies that you would like to invest in?
I have nothing against the Polish equity markets, but I'm just so busy doing what I'm doing elsewhere that I leave that to Piotr. Piotr Geller is a DiNapoli expert. He's been with me for years, and he really knows his stuff. He does invest in the local markets here, and does quite well. And any questions that people would have about my techniques, applying them to the local markets, should direct them to him.
Do you think that Polish Warsaw Stock Exchange is the right place for the investor? Do we have the opportunities here?
You definitely have opportunities, and a lot of times if you have a good method, you can apply them in a smaller market, you do quite well. I do think, however, that your local investors should have their eyes on world markets. Maybe not so much Forex, but stock market indices around the world, gold, certainly, silver, oil. These are markets with tremendous opportunity, and opportunity will shift, from one market to the other. So if you're just focused solely on Polish stocks, then your ability to gain profit is going to be limited.
Tell me more about your technique, about your workshops.
The trading technique that I use has to do with leading indicators. The whole attempt is to get out in front of the market so that we know how to interact with price levels before the price gets there. And then once the price does get there, we have means of measuring whether or not we should stay with a trade. It's not just Fibonacci based, but also there are other leading indicators that I've developed over the years. The idea is primarily to get out in front of the market rather than to use lagging indicators, which always, by definition, are late.
Joe, my last question. What do you think about Poland in general?
Well, I love Poland. I've been coming here now, I think, something like 16, 17 years. When I was invited to do this conference, memories of Zakopane came back to me, and the conference in Zakopane was fantastic. Well run, beautiful place, and so I was very anxious to come back here to Karpaz. Any chance I have to come to Poland, I take advantage of it. The people are very friendly, very nice, and I love the mountains. I can't say enough good about Poland, frankly.
Thank you.
It's true.
Thank you very much. Thank you for the interview, and I hope you will enjoy the Wall Street conference.
Well, my pleasure entirely, and again, thanks for the invitation.
Thank you.